off, let's just talk about something that's very, very familiar to everybody. It's the same old song and dance. Now get close with your insurance buddies and your insurance carriers. Get them NMLS licensed if you really can, if you want to cement the relationship. Now, why is this? Well, because of alarming trends that we've been covering over here at Mortgage Shots in the National Real Estate Post for the past couple of years. But just look at this as another monumental leap forward in the fees that you're going to have to pay, not only one-time fees, but also your 30-year over fees. So get a load out of this, and this information comes from Unsurfy, an insurance comparison website, and it's reporting that homeowners policies non-renewable rates in the state of Florida tripled over the past 5 years, with the numbers spiking 280% from 2018 to 2023, and this is the steepest rise in the nation. But as we always say over here, it is coming, my friends, to a market near you, as it always is the case. But get a load of this. Florida's non-renewal rate in 2023, where they just said, you're out of here, was 2.99%. Louisiana, for obvious reasons, hurricanes and storms, had the second highest non-renewal rate at 1.8%. At time of renewal, which usually comes once a year, insurance policyholders make their customers new offers, and these can include different terms, such as a change in coverage, as well as higher or lower premiums. Now, what side of the aisle do you think that falls on all the time? Customers then get to either accept the offer with a gun to their head or just go another way with another insurance company. And did you know that about 20% of all Floridians right now, homeowners, are choosing to go completely uninsured? That's a problem. And I got news for you before you guys think you're safe. Did you know that those Floridians, all those Gen Xers, all those baby boomers, they have more money than people in your state? So how the hell is this going to work when it comes to you? Because I'm no mathematician. It goes something like this. Get your insurance up front. Right away, become close with that insurance person, because it is going to be a DTI and a deed of trust deal breaker waiting to happen for you. So assuming you now how to read a graph, I first want to show you this without any numbers representing anything about this whatsoever. Here it is. So for simple observational purposes, does anything on this graph strike you as a little out of the norm? Maybe something that could be a problem? If not, just mosey your eyes on over to the right a little bit more, a smidge. This is unrealized gains and losses on real estate investments from banks. See all of those really big bars on the right-hand side, which we would say is south of the Mason-Dixon line on this graph? Those are bank losses that haven't yet been written off. So 2 observations here. Sure, it does seem like those losses were unusually large considering the history and the numbers that we can see in the past right here. And number 2, when they realize those losses, rates are going to go up and product availability is going to go down on your qualified mortgages, because that's who this is beating the living hell out of right now. Your non-QM loans are going to be a little bit more removed and isolated from the losses that we're going to see from the bigger banks that you're staring out of this graph right now. And because non-QM loans are almost on par with rates right now, and they've got a ton of money coming in, I predict we're going to see non-QM loans priced better than your QM loans. So yes, talk to my friends over at Angel Oak. Have a conversation with them about product availability, because who knows, that's probably where you're going to find your best rate going forward. I hope this helps, and thank you guys for watching, listening, and sharing, and make sure you keep the conversation going on your side. We'll talk to you soon. Ciao.